the allocating agencies are responsible for determining what a reasonable fee is within the context of each transaction as they allocate the tax credits. The IRS is not compelled to accept that determination. Presumably, this discretion will be rarely used and only used to correct an egregious abuse, but listeners should be aware that the IRS is taking the position that they are not bound by what the allocating agency's position is.
Yeah, so the old rule of thumb of, don't exceed 20% may not fly anymore.
Still sticking on the development fee issue, the method of payment, and they get to the intent to pay the development fee note. This topic receives a lot of attention in the guide. The issue is, should the portion of the development fee that is deferred and paid from operations or from some other source down the line be included in an eligible basis? The guide discusses how examiners should go about making a determination of whether there was ever an intent to pay a deferred development fee. On this slide, on page 820, and the next slide, we show the criteria that the IRS has suggested may be indicators that there was not an intent to pay. First of all, they want to know, does the note exist? If you don't have a note, that's something they're going to look at. Does the note accrue interest? Lack of an interest rate suggests that the note is not an arm's length transaction. Does the note or other documentation suggest that no payment is required